Investment bankers are technical experts in finance and they are some of the smartest people to work with. These are the six key hard or technical skills that they are expert in. If you want to become an investment banker, you need to master these skills. In this video, we will uncover each of these six skills in detail and understand what does it mean and how is it used by investment bankers. Alongside that, we are going to provide you with resources using which you can develop on this skill set on your own. Hello everyone, my name is Karan Damania. I am an ex-investment banker turned founder, and through Encoding Careers we help you build successful career in finance. So let's get onto the screen and discuss each skill in detail. Alright, so here we are on hard skills needed to succeed in investment banking. Let's start with the first skill, that is market research. Let us first understand what is involved in market research, and then we will go on to understanding how investment bankers are using market research. So market research involves analyzing industry trends, competitive landscape, market sizing, regulatory environment. So here let's take each of the one in detail. So industry trends. Whenever a client comes to investment banker first of all research about that particular industry. So let's assume that a research was created for skin and hair care industry. So investment banker will be analyzing what is the industry currently up to. So is it growing in the past 5 to 3 years? What is the future outlook of that industry in the growth terms? They will go through some of the research reports created on that particular industry and create a research on their own for their understanding, as well as to explain to the clients about what the industry outlook is, and they are using these industry trends to understand if the client is to be workable upon or not. If the industry is very stagnated, then they will avoid those kind of clients and will save their time for some other industry clients. So that is how industry trends are used. Next is competitive landscape. This is one of the most important research that investment bankers are creating, and it helps them a lot in providing insights to the client as well as themselves. So in competitive landscape, the investment banker will be analyzing 4 to 5 competitors of particular client, and in that research they will go on to understand financials of competitors for 3 to 5 past years, for the valuation of the companies that are considered as competitors, for the range of valuation, that for the range of funding that those clients have, those competitors have raised, so that based on the entire research that investment bankers are doing, they can provide insights and recommendation to their client on how they should go ahead and do their funding, how should they map out their entire valuation. Investment banker get very much broad understanding through this competitive landscape research. Next, we have market sizing. This is similar to industry trend, and most of the time both of these are combined, like the industry trends and the market sizing, where they are analyzing what is the entire market size, so that they are not trapped in very niche industry which do not have lot of customers, and the growth opportunity is also very small. Here, analyzing market sizing is about understanding what is the growth rate that is expected in the overall market, which are some of the pockets in the economy that are expected to grow fast in the coming years. And finally, we have regulatory environment. As investment bankers are working across lot of industries, over here they are tied up with lot of legal firms to have some talking points with the client. They are analyzing regulatory environment themselves as well. So for an example, if an NBFC client is coming to an investment banker, they should be aware about what are the regulations, what are the changes happening for the NBFC sector, so that they, when they meet up with clients, they can discuss and have intellectual conversation with them. So that was about a brief of market research based on the types that are there and what does each type mean. Research helps identify growth opportunities, risks, and business context around the company. So here we understood that we can get to understand about growth opportunities. Risk is also a very good element. So when we understand that some industry is very niche and the market size is also very small, it will be a risk for us if we go ahead and pursue clients in that particular industry. So we are, as an investment banker, trying to stay away from that. Next, we are going to understand how investment bankers are using market research. So before pitching or executing a deal, analysts research the client industry, so that we understood that there is a detailed industry trend and market sizing that investment bankers are doing. They are benchmarking competitors. So for the client that is coming to meet with investment bankers, they would already have done a competitor research, so that they would have talking points. They can pitch the clients of how they should go and structure their entire deal, if they should go for funding or if they should go for M&A. So that is how they are working with competitor research. And the final point is assessing tailwinds and headwinds. Tailwinds are like opportunities and headwinds are like the challenges. So that is how investment bankers are using market research. It builds the strategic story of why the deal makes sense. So based on the research that investment bankers create, they are convincing client that the deal structure that we are recommending you is going to be successful and makes sense. So that is about skill number one. Next, we have a resource that you can use. We have created a very detailed competitor research based on the skin and hair care market. So here are some of the snapshots for that. You can download this detailed research using the download button, but before that you need to download this entire PDF, for which the link is in the description. Once you download this PDF, you will be able to go through all the resources that we have provided and download each of them. So in this research we have taken 9 competitors, we have given the objective and methodology of the research, we have done a detailed 5-year financial analysis of all the competitors. That is how you can also do competitor research based on the industry that you want to target. Next, we will move on to second skill, that is financial analysis. So as we understood that in the previous skill, before a client is getting onboarded, investment bankers are doing research around industry, the competitors, and providing client that research and making them convinced that they should go for the deal. Now once the client gets onboarded, they will share their financials with us, and then the work of investment banker is to do a financial analysis. Let us first understand what is financial analysis, and we will then see how investment bankers are doing that. So financial analysis includes reading financial statements, that is profit and loss statement, balance sheet, and cash flow statement. Next is calculating margins, ratios, and trends. So here, based on the financial statements that you have been provided, you need to calculate margins. Now these margins will be various types like gross profit margin, net profit margin, EBITDA margins. So there are different kind of margins that you calculate. Then you will calculate various ratios. So in ratios also there are various types: liquidity ratios, solvency ratios, profitability ratios, and the trends. So trend is like comparing on the historical basis. Is the company growing in the last 3 years? What is the trend? Is it in uptrend? Is it stagnated, or is it in downtrend? So these are the trends that we can see. Next is identifying profitability and growth drivers. So when you go deep down into financial statements, you understand what are some of the sectors or segment of the company that are growing very good, and some of the sectors which are growing very bad. So financial analysis helps assess a company's financial health and performance. So that is what you can understand through financial analysis. Now, how are investment bankers using it? So point number one, to evaluate if a company is viable target or ready for fundraising. When you go through financial statements, you see about the revenues that the company is doing, you see the profitability. If the company is very small in size, then it won't be able to sustain in the market when they take huge amount of funding. So for that, investment bankers are looking at company who are stable, who have good assets under them, and are ready to raise fund and expand their business line. So that you understand through financial analysis. Next is analyze KPI, unit economics, and EBITDA trends. As you must have seen on Shark Tank that they are doing unit economics. What is the revenue? Then what are some of the expenses that are subtracted out of the revenue, like the salary, the marketing cost, administration cost, and you arrive at EBITDA. Then you subtract the depreciation. So all that unit economics can be calculated through financial analysis. Then you also get to understand about the KPIs. KPIs is key performing indicators. So as we understood that you can go into each of the business segment, and finally beta trends, and finally spot red flags or opportunities. When an investment banker will do financial analysis, they will go through the balance sheet. In the balance sheet, they can assess whether a company is heavily levered. It is a very negative sign when a company has a lot of debt on its book. And similarly, there are different red flags that they can assess while going through the financial statement. These are 3 points that investment bankers are doing through financial analysis. It is critical before valuation or due diligence. Before providing our financial statement for due diligence to outside firm, it is better that investment bankers do on their own and then start doing the DD process. Next, we have a resource of financial analysis for you. As you can see in the image below, we have created a detailed template where you have to just plug in numbers and there will be ratios calculated automatically. This will be very useful when you want to understand the basics of the company. Here we have tried covering some of the basic ratios like profit margins. Then we have the payable days, receivable days, fixed asset turnover. You can once again download using the download button. Investment bankers create a template for entire financial statement analysis. This helps them to reduce the time applied and improve their efficiency. Next, we have skill number three, that is the most important one, financial modeling. Let us first understand what financial modeling involves. and then we will move on to how is it used for a deal. Point number 1, building three statement models. Continuing with our deal, in the first step, investment bankers are creating research to understand the market landscape. Next step, they are working with the client to analyze their financial statements. Based on that, they have made a decision that let's go ahead with this deal. Now when you are starting to work upon a deal, you create a financial model for the company to calculate the valuation. Now financial model will be created for all the type of deal, whether you are going for merger, whether you are going for acquisition, or you are raising funds through VC, private equity, or anybody. So for that, financial model is necessary. Now in financial modeling, the first step is building three statement model. Here you are projecting profit and loss statement, balance sheet, and cash flow statement for the next 3 to 5 years. We have created a detailed series on financial modeling for a startup where we have covered step by step of how investment bankers are creating a financial model. You can check that entire video series, link in the I button. For now, let's continue. The second point is forecasting future performance. To calculate each of the three statement model, you need to forecast how will the business be doing in the future years. If investment banker has a client, let's say a skincare company, for the investment banker, they will have to take assumptions that will show the future performance of the company. If there are 10 products, how many number of products are we going to launch in the future? How much is the average price of each of the product? And then how many products are we going to sell every year in the future? That is how future performance of the company is projected. And finally, step number 3, you are linking assumptions to the output. So when you take the entire assumptions, as we understood now, you are then linking this and creating your entire P&L statement where you are projecting revenue based on this assumptions. That way you create assumption for each and every line item. This we have covered in detail in the entire financial modeling of a startup series. You stimulate how the company might perform under different scenarios. A lot of time investment bankers are creating financial model for various scenarios. That is, they are considering three different scenarios. In number one, that is company is going to grow very well. In the next case, they are assuming that company is going to grow in moderate growth rate. And finally, they create a worst case scenario. That is a brief about financial model. Now, how is it used in a deal? In a live deal, you use model to project cash flows, profitability, and capital needs. This is the most important thing. You are projecting cash flows because based on the cash flow, you are now going to calculate valuation of the company using a DCF model, that is discounted cash flow, which will compulsorily need projected cash flows for the next 3 to 5 years. You will be able to calculate the profitability which investors are looking out for. Now, when you are going for a fundraise or M&A, at that time you need to showcase how the company or business is going to be profitable in the future, and that will be done through financial model. And finally, capital needs. Here you will understand how much capital should we go ahead and raise based on the model. Point number 2, support pricing in M&A, fundraising, or debt structuring. As we have understood that based on financial modeling, a valuation model is created, and that will help you create a pricing for M&A and also in fundraising. Or if you are going to raise debt, then you will not calculate a valuation model, but you will create a detailed payment restructuring model using this financial model. And finally, point number 3 is answer what if questions from the client. Your financial model will be used for answering the questions that are being put up by your clients or most of the time investors. Based on the above point, models become the backbone of decision making. So that is about skill number 3. The resource for skill number 3 is attached with skill number 4, and we have created a detailed financial model plus valuation, which we will see after this fourth skill. So skill number 4 over here is valuation techniques. First, we will understand what type of valuation techniques are there. Number one is DCF, that is discounted cash flow. It is most widely used and it is very detailed and time consuming model. For calculating a DCF model, you will need a detailed financial model, which we saw in skill number 3. So after your client gets onboarded, you create entire financial model. The next step comes on calculating the valuation for the deal. That is done through DCF, where you have the projected cash flows and you are discounting it to the today's value. If you want us to create videos on DCF valuation, do let us know in the comments and we will create a detailed series on that. So that is about point number 1. Next, we have comparable company analysis, where you are seeing various competitors in your industry and what is the valuation that they have received for the deals that they have done. And based on that, you are giving multiples to your company. So that is comparable company analysis. Next, we have precedent transaction. Precedent transaction is similar to comparable company, but here only M&A transactions are being taken into consideration. What is the multiple that was given to your industry competitors when they went for an M&A? So that is about point number 3. And finally, we have SOTP, that is sum of the parts valuation, and LBO. Over here, SOTP is used for very big companies. For an example, company like Reliance, which has so many segments under it, like Geo Cinema, Reliance Smart. Then they have the main business of oil and gas. That is, everything is combined into one Reliance Industries. Now, some of the part valuation will divide each of the segment and give a value to it. Each of the segment is taken into consideration separately. A model is created for each of them and a value is assigned to it. And the final one is LBO. LBO is mainly used in private equity transactions when private equity companies are acquiring companies through debt. Now, LBO means leveraged buyout. Based on the term, we can understand that a company is being acquired using leverage, that is debt. The fourth valuation techniques, SOTP and LBO, are advanced ones, and when you understand the basic ones like DCF, comparable company precedent transaction, then you will be able to model out the LBO and SOTP valuation. But initially, you will have to start learning about financial model and how it is created. Using all the four valuation methods, you can calculate the enterprise and the equity value. Next, we are going to see how valuation techniques are used in a deal. Number one, it is used to justify the price of buy side or sell side deals. As we understood that valuation is created when a company is going for fundraise or M&A. Entire valuation model that you build out will be used as a justification thing, that this is done using all the research, all the comparable companies, all the transaction taking into consideration. You create an entire range, and that range is used to justify the value of your clients, and that can be used for the buy side deal as well as sell side deal. So if investment banker is working for a client who wants to acquire company, and they will create valuation model for the company who is getting acquired and will pitch it to them, and that entire amount will be paid by the buy side client to the company who is getting acquired. In the sell side, it works in the opposite manner. Then we have benchmarking valuation in pitch deck. In pitch deck, investment bankers are putting valuation range of using each and every valuation. So a DCF valuation is calculated, they will get a range for that. Then they use comparable company analysis, they will get a range for that. And based on it, they will create a detailed football field analysis, which is being portrayed into the pitch deck. And the third step is drive negotiation discussion. During the conversation with client, you will have detailed pointers on valuation. The buy side client who is going to acquire company will want that the valuation should be less, because they are going to pay money for it and they don't want to spend a lot. Over here, having firm backing of the entire valuation will help you negotiate deals better on your side. Valuation is what clients care most about. Whenever you will be having conversation with the clients or going for meetings, most of the times each and every client will ask what is the valuation that we can get in the industry, what will be the price the buyer will be able to provide us. So that is what the entire thing is. And if you are expert in valuation technique, then you are going to have a great career in investment banking. This is the resource that we have created for you. It includes a detailed financial model. As you can see in the image below, there are a lot of sheets that we have included. It has cash flow, it has balance sheet. Before cash flow, there is the entire financial model, and after cash flow, we have the entire valuation part, where we have calculated valuation using DCF method. It includes all the formulas and linking so that you understand how is the assumption taken for a particular line item. So you can download using the download button. Also, to understand about DCF valuation method, we have given you a detailed valuation guidebook which helps you go through each and every step of how a valuation model is created. It is a 9 step process that we use to create this valuation model. You can go through each and every 9 step in detail through this valuation guidebook. The next skill that you will have to learn is using financial softwares. First, let us understand what are some of the common financial tools or softwares that are used in investment banking. Number one, Excel, which is the most important, used for modeling, analysis, data cleanup. Next is Bloomberg Capital IQ, which will be used for data sourcing. Next is PowerPoint to create pitch decks. And finally, data room tools for due diligence. This financial software over here, Excel, you can easily understand that whenever you are working on any financial element of the deal, you are going to use Excel, as it is most convenient and there is no tool similar to it. Second, we have Bloomberg Capital IQ. When you are creating various research reports, you are going to use these tools to get data for like competitors in the industry, what is the deal valuation, what is the deal pricing, gather everything using that. Next, we have PowerPoint. Nowadays, lot of investment banks are using Canva as well to create more enhanced decks. So PowerPoint and Canva will be tool number three. And finally, you have data room tools. When client provides you information, you are using various tools like Google Drive. You are using various document uploading websites like Dropbox or something, where client will provide their documents and you will have a look to it. So that is termed as data room. Next, let us understand how is it used in a deal. So Excel is definitely used to build models and track financials. Capital IQ Bloomberg is used to pull peer data. Now the financial softwares are not the fifth step of entire deal process. They come at every step. So here we are just trying to understand what are the tools for every step that we have considered. And final third point is PowerPoint, which is used to create pitch deck, teasers, and investment memorandum. Efficiency and accuracy separates a good analyst from a great one. It will be very important how you are going to use this financial software, and the analyst who is better in using them will get ahead of others and be able to stand out. So to get better on using these tools, you will have to start working on yourself. For Excel, you can create a financial model that we have in our entire series, and that will help you learn Excel. About Capital IQ and Bloomberg, you can watch various tutorials on YouTube and also go through their mock websites which help you simulated version of this tool. And finally, PowerPoint, you can use Canva if you don't have PowerPoint and create some presentation which will help you improve on your presentation and storytelling skills. We do not have any specific resource for this, but all the resources that we have given you will help you upskill on the financial software uses. And the final skill that we have in the hard skill part is building presentation. The IB presentations include pitch deck, investment memos, information memorandums, management presentation. You package insight, numbers, and strategy into visual form. These are type of presentation that investment bankers are creating. Pitch deck will include a lot of information on the company, on the strategy of how they are going to move ahead after the deal is executed. What is the story of the company in the past? That is a very brief about what is included in pitch deck. Investment memos are very short deck, like 10 to 5 pager material, where it is explained in brief about the company. The company is not named over here, and they are sent out to all the investors that an investment banker has in their database. So if they are getting request from any of the investor, they will send out the detailed version of pitch deck or information memorandum to them. Information memorandum is also termed as SIM, that is confidential information memorandum, where it includes detail about the company, each and everything. It is around 100 to 150 pager, includes the past, present, the forecasted, and everything that investor will need to make decision for the company. And finally, management presentation. These are some kind of strategy decks that are created, or business development deck that the client needs on their business. Now, how is it used in a deal? Present deal rationale to clients or investors. So as we understood that pitch deck or the SIM, that is confidential information memorandum, are sent out to investors. They will be having entire deal structure and how the investment bankers are helping client in the deal process. So that is the entire deal rationale that is portrayed through presentation. Number two, summarize company story plus valuation. And finally, number three, often the first impression a buyer or investor gets. As before the investor meets a client, they are going to see the investor deck or the pitch deck that investment bankers are sending out, and that's why it should be very clean, precise, and easy to understand, so that the buyer or investor gets a view of the company and they are interested into going ahead with the deal. So that is entirely about building presentation. Your style, your slides tell the deal story. Every slide you create should have a linking with the previous and then upcoming slide, and that is how the entire flow of the presentation should be created. We have a resource for you, that is a pitch deck guide, where you have an entire template of how a pitch deck is created, what are the elements of entire pitch deck, like the about us section, like the journey so far. You also try to include the KPIs of the past, of the future forecasted, and create the entire presentation. You can download using this PDF. All right, so that was it for the first part of investment banking skill set, where we understood each of the hard skills that are needed by an investment banker. In the next video, that is the second part of this entire mini series, we are going to cover the soft skills that you need to develop so that you can excel your career path. So see you in the next one. Until then, this is Karan Damania taking your leave.